Hello and welcome back to the channel. Now this video is going to be Endgame, the death of the dollar. This is going to be part one of a 4-part series talking about bigger picture stuff. So where we are within the current economy, how we got here, and the likely paths ahead of us. The vast majority of people still fundamentally don't have any idea what is going on in the wider economy and the bigger macro picture and bigger macro framework. And this stuff is important to understand, to know where we are going and the likely paths ahead of us. You know, most people out there still think crypto is some sort of scam, and they think it's just basically magical internet money that is a bubble and it's fundamentally going to zero. And the reason a lot of people think that is because they have no idea what is going on in the wider economy. So this series is going to be trying to build that bigger picture of just how messed up things really are. So before we get into it today, guys, don't forget to like and subscribe. And also don't forget to leave a comment for the algorithm. So today we're going to be really talking about the rise and the fall of the American empire, and this period of the last 100 or so years that has also been known as Pax Americana, this period of sort of peace and stability with America as the dominant world power, in a way policing the world and sort of bringing peace and stability, but really how that has all been centered around one thing, and that fundamentally is the dollar. So we're going to start at the dawn of the 20th century during World War I. And during this period, Britain was the dominant world power, and they had the exorbitant privilege of having the pound as the world reserve currency. So during this period, the pound and derivatives of the pound, so debt denominated in pounds, was the base of the global financial system. And really that started to unravel during World War I. And to pay for World War I, which was extremely expensive for Britain, war bonds were issued, where the British government basically sold all of these bonds with a promise to repay. And initially, these were hailed as a great success, and they were hugely oversubscribed, and that people were basically flocking to buy these bonds. Whereas in reality, only around 33% of the bonds issued were actually purchased by the public. And the rest had to be placed on the balance sheet of the Bank of England. And the Bank of England was buying these bonds with newly issued money. So in effect, what that was doing is that was debasing everyone who held pounds or British bonds. And that included not just the British public, but many sovereign nations had, you know, their base assets in British bonds and pounds because it was the world reserve currency at that time. And so that really was the beginning of the end of the pound as the world reserve currency, because they have essentially just debased and in effect stolen the savings and the reserves of many of these other sovereign nations. And so that brings us to America rising as the dominant world power. And so while Britain's power was waning and Britain's influence in the world was falling, America was rising as the dominant world power. And during the 20s, America was setting the stage and leading a sort of technological evolution, bringing a huge amount of prosperity to America and the rest of the world. And they were sort of slowly becoming dominant on the world stage during this period. But in 1929, massive amounts of consumer spending fueled by credit led to the 1929 crash and subsequent Great Depression. And this Great Depression, along with the huge debt burden that had been imposed on Germany in response to the amount of death and destruction that had happened in World War I, which led to the German hyperinflation, basically led to the rise of Hitler. And so from the rise of Hitler, World War II breaks out and occurs and, you know, drags the entire world into this massive war. And the Allies and allied countries who had faced this existential threat basically went out, started celebrating, and had a huge amount of children, which led to a massive population boom. And this population boom is known as the baby boomers. So 78 million boomers were born in a period of 20 years in America, which led to a 40% increase in population in 20 years in America alone. With the overall global population growing by 30%. So basically what's happened here is a huge number of this one particular cohort has been born, and this cohort dwarfs all of the other cohorts in size and basically has a huge number of people within this cohort, which will lead to many, many unintended consequences down the line. And fundamentally, that population boom has actually caused most of the problems that we have in our society and in our monetary system today. So post World War II, the new global rules-based order is born with America at its center. So Bretton Woods really is the most relevant one to this video. And Bretton Woods was essentially the dollar being established as the global reserve currency and all other nations agreeing to peg their currencies to the dollar, with the dollar being pegged to gold. So the dollar basically tied itself to the gold standard to give it value and to make itself that world reserve currency. So the dollar used to be a very hard form of money, with it being tied to a real world physical asset, with that real world physical asset being the previous form of money and the world reserve asset, which was gold. And on top of this, America established this much more globalized world with these multinational organizations such as the UN, NATO, and eventually the EU being established. So, big powerful nations working together instead of working alone. And also the 1947 Trade and Tariffs Agreement basically lubricated the global financial system and made trade between countries much more efficient and much more frictionless. And so post World War II, America experienced essentially the last golden age that it experienced in the 1950s and 1960s. And this period really was massively associated with the rise of the middle class in America. So two notable things was the Marshall Plan, which was the United States essentially providing huge amounts of monetary aid to Western Europe following the devastation of World War II in the form of stimulus. And this really rebuilt the European economies and allowed trade between America and Europe to pick up and make everyone a lot more wealthy. And then also the fiscal stimulus of the 1950s. So taxes were cut and public spending and infrastructure was invested in, essentially injecting a huge amount of money into the American economy. And so there was some inflation during the 1950s, but there was also real productivity and GDP growth. So the inflation wasn't particularly sustained or particularly high. And also there was the technology that had been developed for World War II was now being transferred for use in these consumer goods, like the television and like the radio. And so this really was a golden age for America, with a huge amount of the population experiencing increased standards of living, with consumer goods getting cheaper and also wages rising. And so a lot of the politics of nostalgia sort of points back to this age within American history as the period that we need to go back to. But likely that is impossible, and we'll get into why. So that accounts for the 50s and 60s, but then late 60s and then through the 70s and 80s, the baby boomers started entering the workforce. And bearing in mind that these baby boomers was a huge population shock, it was a 40% increase in the population in 20 years. And so the early boomers entering the workforce from 1967 had it good and had that tail end of the golden age. But as more and more boomers started entering the workforce, and the majority of boomers were in the workforce by 1975, inflation really started to take hold in America and in Western nations. And this period from the mid-60s to the early 80s is known as the Great Inflation. And this inflation was essentially due to consumption. If you think about all these boomers entering the workforce, they suddenly have disposable income. They go out, they get a loan to buy a house, they buy consumer goods. Basically, it was huge demand-driven inflation due to the population boom and due to the amount of people who were now consuming goods, and that increased number of people consuming goods. So these baby boomers entered their working lives with a period of huge inflation and then quite a lot of economic instability due to that inflation. And so moving on a bit, America was running twin deficits, which means government revenues are lower than the government expenses, meaning they're spending more than they're making, and the price of the country's imports is greater than the income from its exports, again, meaning they're spending more than they're making. And this is a huge problem because the dollar is pegged to gold still. They are still on the gold standard. And because there is only a finite amount of gold, and America is spending more dollars than it's making, and the dollar is pegged to gold, essentially they are spending all of their gold reserves, and they only have a finite amount of these gold reserves. So in 1971, Nixon makes the decision to take America off the gold standard, which is essentially a default. It's saying we cannot afford to pay for what we are consuming. And this is the first time in history that every single currency has been unbacked by anything. Because remember, all other currencies were pegged to the dollar, and the dollar is pegged to gold. And suddenly that dollar to gold peg is broken. So now every single currency is now free floating and pegged to absolutely nothing. And this is the first time in history that this has ever happened. You know, we have a severe recency bias where this is kind of normal to us, and it's been our entire lives, you know, depending on how old you are. But really, this is a very, very short window of history. It's only been around 50 years. So really, it is a blip in history. Now, from this breaking of the gold peg, that seriously threatens America as the global reserve currency, because previously all other currencies would need the dollar because the dollar was convertible to gold. But now that the dollar is no longer convertible to gold, there's not really a huge need to have the dollar. So America sets up the system known as the petrodollar, where basically during this period, the US struck a deal with the Saudis. And the deal was sell your oil only in the dollar, and in exchange, we will offer the military protection of the American army. And the Saudis agree to this because that military protection from the American army is extremely tempting. And then from this, all of the other OPEC nations shortly followed. And this basically ensures that the demand for the dollar stays strong, because instead of needing the dollar for gold, all countries need oil. And so to get oil, you have to have the dollar, which therefore keeps the demand for the dollar strong and keeps the dollar as the global reserve currency. And so this brings us back to those boomers who had now entered the workforce. And because this was such a huge population bulge, the boomers are essentially competing with each other for wages. You know, there's now a huge surplus of workers in the Western world. And so what that means is that there has been a huge decoupling of wages from the real economy, because labour is now plentiful. And so since 1975, average real wages have risen by 0.3% a year, and productivity growth skyrockets, but wages stagnate. These boomers who grew up and they had been essentially promised the American dream enter the workforce, and the reality is very different from what they were promised. They never got the American dream, and fundamentally it was all a function of demographics, because they can't outwork the fact that there is a huge surplus in labour. So again, this was a period of economic and political instability, because GDP and assets were continuing to rise because productivity was still rising. But however, wages were stagnating. You know, people were extremely unhappy about this. And then Margaret Thatcher, the Conservative Prime Minister in the UK, and what she effectively does is gives away or sells for a very below market rate all of the council housing within the UK under the Right to Buy scheme. And what this essentially did is that all of these people who were previously creditors and didn't have any debt at all of a sudden now have debt. So they turn from creditors, from lenders, to borrowers. And Ronald Reagan sees what's going on in the UK and applies this to the US, and basically begins a massive deregulation of the credit market. And once again, turns all of those people who were previously creditors and lenders into debtors and into borrowers. And this period coincides with essentially the rise of Wall Street and the financialization of everything. You know, this was the period of where we started moving away from industry and towards financialization. You know, back in the 50s and 60s, the biggest and most profitable companies were essentially industry. There was, you know, steelworks and oil producers. And then during this period, the shift happened from industry to finance. And now the most lucrative business is the business of money and the business of debt. But this was basically a way for these boomers to finally get what they were promised. Because if your wages are no longer going up, but assets continue to rise, then how do you get the American dream that you were promised? You take on debt and you buy those assets. So the story continues, and then in 1987, the Wall Street crash, also known as Black Monday, occurred. And this was due to a number of factors, but debt, rising interest rates, and also liquidations of overly leveraged traders contributed to this. And then in response to this crash and this panic, Alan Greenspan, who was the chair of the Federal Reserve at the time, cut interest rates to stabilize the stock market panic. And it works. It avoids a recession, and there is no recession. So what the Fed have done is they have basically stopped the business cycle, and rate cuts are now a tool in the Fed's toolbox. So when a panic happens, when this period of potential deflation happens, and, you know, declining economy and declining GDP, the Fed now knows that they can step in and use rates to stop that cycle. and to continue the good times. And so in 1995, the World Trade Organization was set up. And what this did basically is allowed trade between all countries, and it allowed you to manufacture in one country and sell in another country. And so these poor boomers who were competing with each other for jobs and their wages had stopped going up are now competing against the global marketplace. And so they're no longer just competing against Americans, they're now competing against third world countries where cost of living and also cost of labor is extremely cheap. So they're now competing against the global marketplace. They also have a high amount of debt due to the financialization that has gone on. And the third and final thing is the rise of the silicon chip. So they are now also competing against computers. And US industry just cannot compete with the cheap labor abroad. So basically any industry that has tried to stay in the US and continue to hire American workers was gutted, and they just simply could not compete, which is one reason that the United States now has a massive trade deficit and they import far more than they export, because American workers essentially just cannot compete against the global workforce. And then in 1998, the Asian crisis happened. So basically Asian countries, which were emerging economies at the time, but fast growing economies, were borrowing too many dollars to accelerate this growth. And then as interest rates were rising, they realized they were massively over-levered and could not afford this debt, which led to a huge global shortage of dollars compared to the debt burden that actually existed. And so once again, Alan Greenspan cuts rates and tries to weaken the dollar to bail out these Asian countries, because those markets going down also affects the American economy and potentially will lead to a recession in the US, which obviously the USA does not want. So now that is the second time that the interest rate has been used as a tool to try and avert financial crisis and to try and keep the good times going. And then in the 2000s, the dot-com bubble occurred. And so by now, smart money has basically realized that whenever there is some sort of panic and whenever there is some sort of deflationary event, the Federal Reserve will step in and cut interest rates. And so this basically gives them the confidence to go all in. And this leads to the biggest stock market bubble that the world has ever experienced. And once again, they were right. When the panic happened and when the bubble finally popped, the Fed once again steps in and lowers interest rates to try and stop the business cycle. And a pattern is starting to emerge where those who are taking on a lot of debt and those who are taking on a lot of leverage and are not feeling as much as they should be the feedback loops of the natural economy, because the Fed keeps stepping in and makes this debt cheaper and cheaper to own. And then in 2008, the great financial crisis happened. So basically, these boomers who had previously been in the stock market become disillusioned and the bubble moves over to the housing market. And that is sort of spurred on by bad mortgage-backed securities and also deregulation of the banking system. So basically everything is massively over-levered and eventually everything absolutely collapses. So once again, the Fed cut rates, and this time the Fed have to cut rates all the way to zero. But this time cutting rates is not enough, and they cut to zero, so they have nowhere else to go with interest rates. And so what they do is they introduce something called quantitative easing, which essentially is a fancy term for saying they print money and they bid the collateral, which is this bad debt, and they prevent the collateral from going to zero. And they do their absolute best to prevent the disinflation and deflation from happening. And it works. 2008 should have been the worst collapse since 1929, but once again, we were saved. And the Federal Reserve stepped in and saved the economy. And in the wake of this, the Occupy Wall Street movement emerges, and the sort of growing anger at the system starts to emerge, with people not really knowing what they are angry about, but just this growing sense that something is not quite right and the economy is no longer working for the average person. And so the story of this and the pattern that has emerged basically is that the Fed will step in any time that there is a crisis that happens, and they will do their best to try and avert this crisis and to keep the good times going. And they are more than likely good intentioned by doing this. They are, trying to improve people's lives and to keep the economy strong and growing. But basically, this has had huge unintended consequences. There's this concept of the conservation of economic energy. And so all this debt that has previously been built up in the past throughout these various crises and various bubbles, instead of allowing the natural economy to do its job and to sort of wipe out those who are over levered and let the restructuring happen naturally. They basically step in and try and save those people who have taken on too much debt. And now there's a book called The Price of Tomorrow by Jeff Booth, and he uses an absolutely fantastic analogy on this, where various communities that live sort of close to nature around the world will occasionally have, annual forest fires and burn all of the dead foliage that has collected and fallen onto the ground in the bush. And by having this annual small forest fire, you are allowing all of the dead collateral to wash away and to burn away. But if you don't have these annual forest fires and you let it build up, then eventually you will have a huge forest fire. And so you have to have these annual small forest fires in order to prevent that one huge catastrophic forest fire. But essentially what the Fed has been doing, they have prevented these mini forest fires from occurring every time they break out. But in doing that, they have allowed the sort of, dead foliage and the amount of collateral in the system to build and build and build and build. And so we are now essentially facing the biggest forest fire that we have ever seen. You thought the 2000 stock market bubble was bad. You thought the 2008 housing bubble was bad. Well, the debt burden that exists now is far beyond either of those two periods. And so this introduces us to something called the long-term debt cycle. So this was a term introduced by Ray Dalio, who's a hedge fund manager, who basically studied history and noticed that over these long periods of 80 to 100 years, this pattern happens over and over again, where you have really three trends. You have the straight line, which is the actual productivity growth of the economy, which is something like the discovery and use of oil has, seriously made everyone richer and increased the amount of productivity of the economy. But then on top of this long-term trend, you have these debt cycles that exist. So you have the short-term debt cycle, which is also known as the business cycle. So that's something like 2000, 2008 or 1987, where you have debt building up in the economy, and then you have a sort of mini crash, and then the crash recovers and the debt builds up in the economy again. But each time the amount of debt in the economy from each disaster and each business or short-term cycle builds, and so you're sort of putting in these higher lows and higher highs in the amount of debt the economy has. And most people can kind of recognize these because you have multiple of them happening within your lifetime. But then over the long term, you have the long-term debt cycle, where debt builds up more and more throughout these short-term debt cycles until you reach a peak within the long-term debt cycle. And essentially you have reached the long-term limit of the amount of debt that can be handled by the economy. And that is what happened in 2008. And 2008 was the peak of the long-term debt cycle that had been built up over the past 60 to 70 years by these boomers who, had good intentions and were trying to keep ahead of the wage stagnation that they were experiencing because of that population boom. But this buildup of debt has had and will continue to have severe unintended consequences. And so this graph shows you the relationship and the toolbox of the interest rates that the Fed has, and the relationship that has with the long-term debt to GDP, which is that purple line there, and the Fed funds rate with those red bars on the chart. So you can see that each time the interest rates come down, which generally is in response to some sort of crisis or potentially disinflationary event, while this does sort of stimulate the economy, it stimulates the economy because it makes debt cheaper and it makes people take out more debt, which then therefore grows the economy and prevents this disinflation or deflationary event from happening. So you do prevent the sort of negative deflation that happens, but you do it by making debt cheaper and by making debt more lucrative, and also by making savings less lucrative and less profitable to hold savings in a bank, which then forces people to spend money and stimulate the economy. So you are kind of stopping the business cycle from happening, but by doing that, you're kicking the can of the debt down the road and allowing the debt to build up further and further in the economy. And we have now reached the point where interest rates, have hit zero and there is nowhere else to go. And so because interest rates have hit zero and lowering interest rates is no longer an effective tool because they can't really go below zero for any extended period of time, the only other way to stimulate the economy is to increase the monetary base, which is also known as quantitative easing. And so what quantitative easing essentially is recapitalizing the bank's collateral and preventing the value of the collateral from falling, because in a system where debt is incredibly high, you cannot have the value of the collateral fall. And so what is happening now, also played out in 1929 in America, where interest rates had to go to zero because the amount of debt was unsustainable, and then the monetary base has to grow, or basically quantitative easing or money printing has to come in to offset the fall in asset values. And so the 1930s and 40s really was the culmination of the last long-term debt cycle. And so on top of this, we have this huge debt burden, the highest since World War II. But on top of this, we are also facing demographic collapse. So bearing in mind that that boomer cohort was the biggest cohort of people that America and the Western world had ever seen, well, the subsequent cohorts were not as big as the boomers as a percentage of the population. So now basically the US births as a percentage of the total population is collapsing, and also the labour force participation rate, so the percentage of people employed in the workforce, is also collapsing. So what this means, basically, we are facing the biggest debt burden that we have seen since World War II, and now the labour force is shrinking, and the labour force participation rate drives real GDP. So we have the biggest debt burden we have seen since World War II, and we have a declining trend rate of real GDP, inflation adjusted GDP is trending down. So not only do we have a huge amount of debt, but so the amount we are earning and the productivity of the economy is also going down, making that debt a higher burden. It would be the equivalent of you going out, taking out a loan to buy a huge fancy house, and now all of a sudden your hours get cut by 25% and your wages get cut by 25%. Now all of a sudden that mortgage that you may have been just able to afford now becomes extremely difficult to afford. And that is the situation that the Western world is in. So now these are some charts from Raoul Pal from Global Macro Investor. And if you haven't heard of Raoul Pal or watched any of his stuff, I highly recommend it, because, he is kind of the leading guy in macro at the minute and really helps you piece together a lot of these threads and a lot of these seemingly unconnected events, but actually all are connected. So this is the growth in US population as a percentage versus the growth of GDP as a percentage. And as you can see, as the population growth declines, so does the growth of GDP. And once again, the US birth rate versus the US core CPI also track each other very nicely. So as the birth rate falls, with a 20-year lead, so does the US core CPI fall. So, the inflation that we are experiencing is not demand-driven inflation. We'll get into that a little bit later, but basically all of the macro forces are currently disinflationary, with the population shrinking and GDP declining slightly. What we naturally should be seeing without any Fed involvement is disinflation or deflation. And this one is an extremely interesting relationship. So the black line is the US labour force participation rate, and the red or pink line is the US government debt as a percentage of GDP, but inverted, so it should actually be going up instead of going down. And the amount of debt basically perfectly tracks the labour force participation rate. So basically what is going on is that we are borrowing more money to paper in those cracks of the declining labour force participation rate, and essentially of that declining real GDP that we have. So we are using debt to offset those boomers exiting the workforce and the lowering amount of productivity in the economy. So we are essentially using debt to paper in the cracks of the economy. And then this brings us on to the corporate debt bubble. So in 2020, obviously the pandemic hit, and you have all of these zombie companies like AT&T that are using huge amounts of cheap debt at 0% interest to sustain themselves. And then the pandemic hits, and all of a sudden velocity of money goes essentially to zero and the economy starts to contract. But as we know, default does not exist in this world anymore. People cannot default. So what happens is M2 explodes and the Fed balance sheet explodes. So basically what happens is the Fed steps in and buys all of this bad debt from these corporations and puts it onto the Fed balance sheet. So once again, the Fed has saved the city. We have a very short 2-month recession. Assets go to all-time highs. Optically, everything looks good. Everything looks fine and dandy. But once again, we have just kicked the can down the road. And so this kind of is the end game of an unbacked fiat system. And, you can ask yourself, if things are so bad, then why are asset prices rising so much? Why is the S&P 500 at an all-time high? Why are housing prices continuing to rise? Well, the answer to that is that they are not they look like they are rising because of the fall in the value of the denominator, which is the dollar. And this basically is debasement. It's not demand-driven inflation, it's debasement of the currency. And a way to think about this is, let's say you have a static piece of string, and every single day you revise down what the value of a centimeter is, then every single day that piece of string is going to get longer and longer and longer, because every day that piece of string is worth more centimeters than the day before. But obviously that is only optically, and in the real world it is still exactly the same piece of string as before. And we can see this in asset prices when, instead of measuring them by the dollar, instead we measure them by the Fed balance sheet. So on the top right is the S&P 500, the American stock market, priced in dollars, and it looks like it's going up and it's good times for all. But when it's measured against the Fed balance sheet, which is on the bottom left, you can see it's actually flat and basically has essentially never recovered since 2008. And the exact same thing is true for housing. Housing looks like it's been on this fantastic bull run. 2008 was a bit of a blip, but since then it's been up only. But when you measure housing against the Fed balance sheet, it is actually losing value over time. And so this kind of brings us into the balance sheet. What actually is the Fed balance sheet? Well, to put it simply, the Fed balance sheet is just the assets of the Central Bank of America, or the Bank of England, or any other central bank. So, on the right here, we can see that the red, in 2008, the red starts to absolutely explode, and the red represents mortgage-backed securities, which was the sort of main cause and main driver of the 2008 great financial crisis, with these mortgage-backed securities essentially being worthless because, people were never going to be able to pay the debt that they were taking out. And then you can see in 2020, mortgage-backed securities didn't increase by that much. It was actually treasuries that started to increase on the Fed balance sheet at that time. But the thing that you need to understand is that these assets and this debt, they're not really assets. The Fed is essentially buying them because they are insolvent and because they are worthless, and they are transferring the bad debt from the private sector to the public sector. And they are transferring the bad debt that, say, a bank or corporation took out, and the risk that that bank or corporation should have taken on themselves. The Fed is basically stepping in and buying that bad debt from them and taking the risk from the bank or from the corporation and putting it onto the Fed balance sheet. But fundamentally, the Fed balance sheet is owned by the United States population. So what they are doing is they are socializing the bad debt and taking it from the people who have taken out that bad debt and should, in theory, be bearing responsibility and suffering the losses of that bad debt. But they are now socializing that and putting it on the balance sheet of the Fed. And key to this is that they are taking out debt in order to buy these bad assets. And when they take out that debt to buy these bad assets, they are increasing the amount of money that is in the economy. And so M2 is kind of the measure of the amount of liquid money there is in the system. So that's kind of like bank deposits or easily accessible money, whereas the blue line, which is all sectors, debt, securities and loans, is more of the sort of illiquid money. So, you can't immediately convert a treasury bond to cash, whereas something that is included in M2 is basically, quickly accessible money. And this brings us on to base money versus broad money, which is kind of an important thing to understand as to why we didn't see a huge amount of inflation in 2008. Because in 2008, the Fed started doing QE and buying the bad collateral from these banks. But then from them buying that bad collateral, that money didn't really make its way into the wider system. Instead, it made its way into sort of assets and into the balance sheets of the bank, which is why we didn't see a huge amount of inflation in 2008. Versus 2020, a lot of this money, instead of going on the balance sheet of banks, actually went out into the wider economy and went directly into people's bank accounts, and that money did go out into the wider economy. So the base money is QE alone, and that's when the money is directly transferred to sort of the banks and does not really make its way into the wider economy. But the broad money is that line in blue, and that's when the money does make its way into the wider economy. So you can kind of think of base money as the collateral of the system, whereas broad money is kind of the spending money of the system. So in a gold reserve system, the base money would be the amount of gold that you have, and then the broad money would be the claims on gold that you have, or the dollars in the system. And so the situation we are in now is that wages have been collapsing against assets basically for the past 60, 70 years, partially due to the fact that, we had that glut of labor with the boomers, and partially just because of the fact that all of this debt that is swimming around in the economy basically goes towards buying assets. And so basically, if you do not own assets, you cannot keep up with the debasement with just a job. You would need a 12% raise every single year just to break even, and our future selves are just becoming poorer and poorer if you do not own assets. And I say 12% because the total liquidity index, which is kind of like the amount of base and broad money in the system, rises by about 8% every single year. And then on top of that, having around a 4% CPI per year means that you have about a 12% hurdle rate that, if you don't make 12% and you make less than 12%, then you're actually losing money and losing wealth and losing value. If you make 12%, you're breaking even, and only above that 12% hurdle rate are you actually making a return and making money and increasing the amount of wealth that you have. And as you can see, the total liquidity index also drives assets incredibly well. So this is the NASDAQ versus the total liquidity index, and they correlate incredibly well. And so we talked about unintended consequences. One of the unintended consequences of this sort of policy and this amount of debt that has built up in the system is the wealth gap that has emerged from this. And there's a number of reasons for that, because lowering rates basically helps those with access to credit the most, and the top 1% of society have the most access to credit versus the bottom 20%, which potentially aren't employed at that time. So they have benefited the most from these rates going down. And then also, when you get onto quantitative easing and the printing of new money, there's something called the Cantillon effect. And Cantillon effect is basically, when you print this money and increase the balance sheet of the Fed, well, that doesn't immediately go into the wider economy. And so prices remain unchanged until those dollars actually start, participating in the economy. I could print $1 million and just keep it in my room and never circulate it in the economy, and it wouldn't have an effect at all. But then as soon as I go out and spend it, that will then have an effect on supply and demand and start to drive prices up. And so basically, the first person that has access to these newly printed dollars benefits the most. And so that means that those who are close to the printer are the best off, which generally has been the banks and also those who own assets. And that is known as the Cantillon effect. So basically, you are disproportionately benefiting from money printing if you own assets, or if you are able to spend that newly printed money first. And this graph here very nicely displays that, with the bottom blue line there being the total net worth held by the bottom 50%, essentially has flatlined for the past 30 years, whereas the red line being the net worth held by the top 0.1% absolutely explodes. But interestingly, it very closely tracks the growth of M2, or the growth of new money coming into the economy. So basically, all of this new money and new credit that is being printed and injected into the economy is going to the wealthy, and the bottom 50% are not participating in this at all. So very important to understand here is that, that 12% hurdle rate that we talked about, if you make less than 12% per year, you are becoming poorer. You are becoming poorer at the expense of other people becoming richer, and you are becoming poorer at the expense of the top 0.1% becoming richer. So essentially, this printing of new money is basically a wealth redistribution, with your future self becoming poorer and the future self of the rich and the top 0.1% becoming richer. So, it's not a sort of natural mechanism of the economy. It is, in fact, another unintended consequence of the debt that has built up and of the printing of money to try and lower the burden of that debt. And another unintended consequence from this wealth gap is basically the fracturing that we are seeing in politics right now. So, we are having a huge divide from the left and the right, and politics is becoming more and more extreme as time goes on. And this fundamentally is because people are angry. They have the sense that they are being left behind and that something is wrong and that the economy is not working for them, but they don't really know why, and they don't know what's going on. And so, the left and the right emerge more extreme, and they both look for someone new to blame. And the last time we saw these conditions was in the 1930s in Europe, and we had the same economic conditions leading basically to the same political conditions. When you think about it, fundamentally, politics is downstream of economics, and everything is driven by what is going on in the economy. And these bigger macro forces that most of us don't understand and we cannot control fundamentally drive everything. And that is why we are seeing the fracturing from the left and the right, and politics becoming more extreme. And here you can see the wealth gap. So the bottom 90% and top 0.1% percentage of wealth owned, closing the gap between that. And as that gap closes, that is the emergence of populism, and that is coinciding very closely with the right becoming more right-wing and the left becoming more left-wing. This political fracturing is a result of what is happening in the economy, and is one of those unintended consequences of the Fed stepping in and trying to stop the business cycle and trying to keep the good times going. This is one of the unintended consequences that has happened. And so this leads us to debt to GDP, because the last time we had this level of debt, it was wartime, and all of the spending that we've had has been peacetime. We haven't even had a major war yet. And the unfunded liabilities going forward are basically completely unaffordable. And if the government agrees to keep all its promises on defence and social security and pensions and also, healthcare, then basically the debt would be ballooning even more to absolutely ridiculous numbers like 200% of GDP. But basically there comes a point where debt cannot rise anymore. And this is basically because where there is debt, there is also credit, and there is a lender and a borrower. And for the US to be able to borrow this amount of money, someone is going to have to lend them that money. And people are already starting to raise eyebrows at the amount of debt that is in the system and saying, hang on, can you actually pay this back in real terms? Debt requires a lender, and because of that, there comes a point where debt cannot rise anymore. And there's this really great poem that I love that sort of describes what is going on in the economy at the minute. Some say the world will end in fire, some say in ice. From what I've tasted of desire, I hold with those who favour fire. But if I had to perish twice, I think I know enough of hate to say that for destruction ice is also great and would suffice. And this basically is where the Western world is. The economy and the world can either end in ice and a huge deflationary event and a huge recession like in 1929, but likely even worse than that, or it can end in fire with huge amounts of inflation. And so this gets us onto deflation. Basically, deflation cannot happen. They cannot allow deflation to happen. We might criticize the Federal Reserve, but really, what other choice do they have other than to keep stepping in and to keep printing money and keep bidding the collateral of the system and propping up the debt bubble that exists? Because the alternative is to let all assets go to their base monetary value. So basically that would look like housing falling by 90% and staying there. More than 50% of people in the economy would be unemployed, and that almost certainly would lead to even more extreme populism than we are seeing now. It would be absolutely disastrous for the Western world to allow that to happen. And the last one to go and the last domino in this line of events is the nation state. So, in 1987 and the 2000s, that was Wall Street and the Wall Street bubble and Wall Street being overleveraged. And then 2008, that was the banking bubble and banks being massively overleveraged. And then 2020 was the corporate debt bubble and the corporations being overleveraged. But 2020 and beyond, we are now basically in the stage of the sovereign debt bubble. So it is the nation state that is now bankrupt. The nation state is the last domino in this chain. So, what would it actually look like for a nation state to default? Well, so that would mean America stops paying other nations $1 trillion per year. They would be saying, no, sorry, this is $1 trillion that we owe you. We're just not going to pay it anymore. That would look like America getting rid of its entire army and its entire military. That would look like every single pension fund going broke and every single pensioner and boomer basically having to work for the rest of their lives because all that money they thought they had, it's not there. They can't be paid it. So all this pension that they've worked for their entire life, that is essentially gone. For a nation state to actually truly go bankrupt, it would be worse than anything we have experienced in our entire lives. And the government debt bubble that exists now is getting far worse because of the recent rise in interest rates over the past few years, with federal government current expenditures ballooning to over $1 trillion purely on interest payments. So that $1 trillion is not going towards paying the debt down. That is just going towards servicing the debt and stopping it from growing even more. $1 trillion, which is the current interest payment on federal debt, is around 25% of US tax receipts. So 25% of everything that the US brings in, they would have to put towards just servicing the debt, not paying it down, just servicing it and stopping it from growing. So that would mean 25 cents of every dollar in tax you paid goes towards servicing debt. You know, so we are already basically past the point of no return. And you can see this in this graph here. So the US Fed balance sheet very closely tracks the federal government current expenditures in interest payments with a 33-month lead. So basically what this means is that we are issuing new debt to pay for the interest payments of the old debt. So to think about this, this is like taking out a mortgage, and then when the interest bill comes at the end of the month, you take out a credit card to pay off that interest. You know, you're not actually reducing the amount of debt. You're once again just issuing new debt to pay for the old debt. And so basically the government liabilities that now exist are going to have to go on to the Fed balance sheet, because we simply cannot put 25% of all tax revenue towards paying just the interest on the debt. You know, it would be completely unsustainable, and we would have to cut a huge amount of government spending, which just isn't going to happen. So, you know, if not deflation, then what? The only other solution is inflation. To lower the debt, you have to grow GDP. And this fundamentally can happen in two ways: through debasement, which has been going on since 2008. So nominal GDP rises, not real GDP, but nominal measured in dollars, because the amount of dollars in the economy is going up. So nominal GDP rises in relation to that debt. So the debt burden becomes less of a burden, or through an economic miracle, which would be, you know, a huge boost in GDP and actual real productivity and real production. And basically what the Fed is trying to do is to toe the line between hyperinflation and economic collapse, or, you know, massive deflation and, you know, a Great Depression type event, until that economic revolution does arrive and save us. And that is coming in the form of AI. But basically we don't know when that's coming, and until then debasement will continue, and it will continue to accelerate. So basically the Fed is towing the line between ice and fire, and they are doing their absolute best to keep everything together before it spirals too far in one direction. And this basically brings us on to the fourth turning. You know, the biggest forest fire we have ever seen is on the horizon, either in the form of a great deflation, but more than likely they cannot let that happen. So therefore it will have to be in the form of an inflation. And during this period, during the fourth turning, the transition of power and destruction of the old rules-based order system occurs. And, you know, is this transition through this period going to be a smooth thing? More than likely, this period is going to be a period of, you know, great financial and social strife and turmoil and great trial and tribulation. And so the next episode of this series is going to be getting more into the fourth turning and kind of the period that we are going through now, and what that period is likely going to look like. So yeah, this has been a slightly different video, but I hope this has been entertaining and enjoyable to you. So yeah, thank you very much for watching, and until the next episode, make sure to like and subscribe, and also turn on notifications if you did enjoy this, so that you don't miss the next episode. So thank you for watching, and until next time, cheers.